Good evening, this is ENCA Moneyline, your money guide. My name is Sikim Gabadeli. Coming up on the show tonight. South Africa's private sector continues its uptick despite a weakening economy. The property market set to see mild growth going into 2015 following last year's slight gains. And we give you some advice if you're looking at starting your very own business this new year. All of that and more coming up in the next 30 minutes. But first, here's your top stories. Well, there's some more good news for the economy. The private sector expanded again in December. However, it's by the slowest rate in 5 months. The HSBC Purchasing Managers Index slipped to 50.2 points last month. The drop from 50.5 in November is as a result of a decline in output and new orders. PMI is an indication of the economic health of the country's manufacturing sector. A reading above 50 signals an improvement in conditions, while a reading below 50 shows a deterioration. The index shows local demand for manufacturing goods has slowed. Analysts believe the fall in the oil price is becoming more evident in the latest data. Well, the housing market is expected to continue improving in 2015. According to First National Bank, the average house price in December 2014 was higher than the previous year. Last month, property prices continued upward with an increase of 6.87%. The average house price was 985,405 rand. FNB says the recent drop in oil and food prices could further boost a sector that's seen growth for several months now. 2014 measured as the third consecutive year of real house price growth. Well, John Lewis from FNB joins me for a look at prospects for 2015 in the property sector. John, thanks so much for your time this evening. Well, 2014 wasn't so bad, given being the third consecutive year of actual real house price growth.
No, it was. We've had 3 good years. Look, it's certainly not a booming sector, and it's better that way, I think. Booms create tears at the end. But it's been 3 healthy years, as you say, positive real house price growth. The demand has gradually grown. It hasn't been a major surge, but gradually, and we've had low building activity since after the boom in 2007.
Yeah.
And so gradually supply has become more and more constrained as time goes by, as demand creeps up.
Yeah.
And you've got to a very well-balanced situation.
For the overall index then, how do we compare in terms of real growth from the boom times that we saw way back in 2007?
Interestingly enough, look, in the earlier part of 2004, you had massive house price growth. So if we take it back to the end of 2004, in real terms, only about 2% higher than what we were then.
Yeah. Because
we had a big drop from the real price peak in 2007. We're about 18% down from the end of 2007 in real terms. So over the net result is over exactly 10 years, we've made very little progress.
And the gradual growth that we're seeing now, is it across all segments, or are we seeing others doing better than other segments?
I think the affordable housing sector, the former black townships, I've got an index for that, and that seems to do slightly better in terms of price growth. But there's not much to choose from these days. What we saw in 2012 and 13 was a catch-up of the higher end of the market that started performing noticeably better, whereas in 2010, 2011, the first signs of recovery were on the lower end of the market. That recovered first. So it's a very evenly balanced. Even the holiday towns, after a good number of years of weakness, has started to show more signs of life at the moment. So very well balanced across the board.
Yeah, who could afford a holiday home in the current market?
Yeah.
2015 then, as we get into it, what are some of the indicators that show that we might continue to see some of this gradual growth?
Well, I think what we're having now is an oil price shock, okay, a positive shock, that is. And I think a lot of us we're probably prone to underestimating the positive impact of this shock. So I think people forecasting real GDP growth, real consumption growth, real disposable income growth are probably underestimating the extent of the improvement, because we're going to see inflation, I think, drop like a bit of a stone in the next couple of months. It's not only oil prices that have been slowing down, food prices as well globally, and the rand's been behaving. So this, to bring it to property, significantly more higher real purchasing power growth available for property too. And so I think we could see higher house price growth. Again, we don't expect a boom. We're not a booming 5% plus growth economy, but up into the 8 to 9% range perhaps, for average for the year.
So do you think affordability is going to improve because we're going to see consumers having a little bit more money in their pockets? I mean, is there a correlation?
No, I don't think affordability will necessarily improve. I think affordability of consumer goods will improve. With inflation well below wage inflation, but I think the stronger residential demand will possibly make residential affordability actually deteriorate. 8 to 9% house price growth. I don't think wage inflation will keep up with that.
Okay.
So you've got CPI inflation going one way, creating consumer goods affordability, but house price growth probably tending towards less affordable.
Okay, so those who can afford, then, is there stock available for them to go and have a look at?
There is in a lot of areas. Look, a lot of our estate agents in our surveys have reported stock constraints, but it's not an absolute. There are still the for sale signs. And what I think is going to happen this year is a lot stronger building completions growth than in previous years. We've seen our building confidence index ticking up for quite some time now, and I think this year we'll see noticeable increase in completions. So a lot of new stock coming onto the market, which will probably alleviate supply.
Okay. What have been the trends with building activity?
Not much if you look at the Stats SA numbers yet. You've seen building plans passed starting to grow more noticeably late last year, but not yet the completions. And our FNBB, our building confidence index, that for the residential side has become noticeable in its increase. So it's got to filter into completions in a much bigger way, I think, during 2015.
All right, we'll leave it there. Thanks, John.
It's a pleasure.
John Loos is Household and Property Sector Strategist at FNB. Now, a new survey on China's services sector has some encouraging findings. It comes in the face of weak signs in the other sectors of the world's second largest economy.
Finally, some hope for China's weakening economy. After a host of sluggish economic data, an independent survey shows the country's service sector has grown at its fastest pace in 3 months. The flash services PMI shows activity picked up to 53.4 points in December, with new orders propelling gains. The index is sitting well above the 50 level, which separates growth from contraction. In contrast, a twin survey that measures China's manufacturing sector shrank during the same period. China's economy ended 2014 on a weak note, with expectations of more stimulus measures to be rolled out. But while the nation looks set to mark its slowest growth in nearly a quarter of a century, the benchmark Shanghai index has soared to more than 5-year highs.
People have still got that fear factor about how bad things are. So in some respects, the type of growth that we've got at the moment is a reasonably clean type of growth. It's not with all of the other trimmings of excesses that we've seen in the last decade. So I know it looks pretty bad on the headline numbers, but I think that's the reality check. That's what it's going to be like for the next sort of 5 years. It's going to be of a subdued level of growth, but a lot better quality.
Whether China's economy grows or slows in the coming weeks, the focus is clearly on potential government stimulus measures. And as global markets start 2015 on a shaky footing, that call for action may become even louder.
The Eurozone economy ended 2014 with its worst quarter in more than a year. It's increased pressure on the European Central Bank to act, and quickly.
Failing to shrug off the winter chill, European shares have resumed their sell-off. Worries over political uncertainty in Greece has contributed to a fall in key indices, and energy stocks have declined as the oil price has dropped. With the euro hovering around a 9-year low, many fear European markets may not recover until after the Greek election later this month. The Eurozone economy isn't helping. Further price cutting has failed to improve business activity, with GDP growth of just 0.1%. Germany has managed only a stuttering performance, and France is becoming a serious problem.
If we are going to see further weakness in the French economy, then I think that will really writ large the degrees of concern within the Eurozone very much at its heart. And I think that's going to be the primary concern.
All this puts pressure on the European Central Bank.
Clearly, markets have ramped up expectations of what Mr. Draghi will announce at the January 22nd meeting, and one suspects that those expectations will be hardened up if we see a substantial move into a deflationary environment in the December HICP numbers.
A fall in consumer price data is also expected this week, but many economists believe even full-blown bond buying may not revive the Eurozone.
Bond yields across Europe now are already extremely low, and growth is also extremely low. So you've got to argue that a marginal decrease in interest rates from their already low levels is unlikely to bring a boon to either growth or inflation.
Even with action from the ECB, inflation and growth could remain painfully slow, sparking fears of another financial crisis for the currency bloc.
After the break, with the start of the new year, some New Year's resolutions may have been to start a business. Well, we may just have what you need for that business idea. You're watching ENCA Moneyline, your money guide. Stay with us.